my colleagues from IDCBS, from India, both in Hyderabad and Mumbai, and the guests from KPMG and the participants, all of you, a very hearty welcome and a good afternoon. I think we intend making this session extremely beneficial because we have some greatly enlightened speakers from KPMG. And I think they would, I'm sure, in their respective divisions of verticals they handle, I think they'll give us insights which probably not many people can give. That's the whole idea. And I think in any budget we take, all this taxation bit becomes quite important, because the problem which happens typically is that there's so much to read between the lines. What the FM says in the parliament and what you get to see and in the newspapers, then what you see in the finance bill and the interpretation, sometimes they are mighty different. And to be honest, some things change also between the budget day and finally when the bill is passed, because lots of things, there are lots of give and takeaways, which again create problems. So what I would request my guests today from KPMG, the speakers, would be that without of course being astrologers and some kind of spiritual forecasters, if they can let us know that what will hold and what will not hold in terms of some of these deep set announcements which have been made. So let me not take too much of time. I think as all the participants know that here we are representing the Indo-Dutch chambers from all over the place, all over the country. So I guess the idea is to build upon the corridor which we're trying to create between the two countries. And so the KPMG colleagues can also do a little bit of, I'm sure, some side information on the Netherlands and India bit as well, as relevant wherever it is relevant. I don't think, frankly, that in the budget there has been any kind of major change when it comes to the any announcements on the double taxation treaties or anything to do with such things. But all the same, a few comments will be very welcome, which can help the people who are interested to further the cause of Indo-Dutch relationship can actually look forward and can progress from there. So with that and without much ado, let me request, I think, Prashant Kapoor, who's the partner deal advisory, M&A and PE tax, and the corridor leader for Europe, to kick off the session today. Prashant Kapoor, please.
I think he's probably going to be joining in shortly, because he was here, but it seems to have dropped off.
Yeah.
Meanwhile, Mr. Chakravarti, you may want to also just put up the presentation meanwhile. And you just maybe give.
Sapna will help that. Yeah.
Okay. So,
sure. Thank you.
Okay. So, Nidhi, would you start off?
Yeah, it's done.
Sure. We'll just while we are waiting, maybe let me just do rounds of our introductions, and you've already done that quickly. Rajesh ji and Mr. Chakravarti.
Yeah, sure.
Yeah, so maybe I'll just quickly do that. So Prashant, who should hopefully be joining us shortly, he's like you said, our M&A and PE partner at KPMG, and he's looking at the overall India-European corridor at KPMG. I am Nidhi, and I'm a corporate tax partner focusing also on the financial services sector. And I lead the India-Netherlands corridor for the firm, and hence have had the opportunity to interact with a lot of you. And it's good to continue with that Indo-Dutch discussion and the several initiatives that we take around that. And my colleague Shailendra, he's a GST expert, and he'll throw some light on the nuances about some of the amendments on the indirect tax side which have been made. So let me just begin. Maybe there is some technological challenge which happens to most of us in various meetings or the other. So I don't see Prashant yet, but maybe we can put up the presentation and I can kick it off.
You can, I think, not wasting time, we can put on the presentation.
Sure. Yeah. Thank you. Sure. So we can move on. We just made the intros. Sure.
Yeah.
So, we have about less than an hour, and, we do want to make it interactive and count, and hopefully I'll also allow for some time for any discussion or Q&A. So we've structured this in three parts: a broad intro and an overview and a context setting, to be then followed by specific tax regulatory proposals, both on direct side as well as the indirect tax side. So moving on. If you could move to the next slide, please. Right. So, this budget has had, a lot of policy announcements, which are very, very, path breaking in terms of the directional clarity that there is, and a lot of push on the digital economy. And I think we've seen over a period of time, the Indian government has been very consistently announcing various initiatives. So one of the most talked about provision for this budget is actually the digital rupee issuance announcement, as well as the taxation on the virtual digital assets, which I'll talk about a little later. But essentially talking about the whole digital currency, the digital financial ecosystem. And we saw that the government has already been taking a lot of steps in the direction of digital payments, and several initiatives have been made over the last few years. And this budget has further sort of made another announcement, also on the digital rupee side. And if Prashant has joined,
Prashant is already joined, Nidhi. I think.
So I'll hand it over to Prashant. Please, Prashant.
Welcome back, Prashant.
Yeah.
Yeah, I'm so sorry. Actually, I got logged out, and then I was finding it a little difficult. So sorry for that. So while Nidhi has stepped in, so basically this digital rupee, I would say the VDA, or we call it as blockchain, whatever name we look at it. So this was there in the news for a while, and it's good that the government has come up with a plan, a much more I would say a focused way forward, where the regulator will also going to start creating a platform wherein all sorts of virtual assets can be transacted. So of course there is a full taxation regime for it. It has been come as a separate, I would say, focused tax provisions, which I'm sure Nidhi will go to include it in her presentation. The impact, this impetus on the manufacturing and the startups. So of course there is a, there is a clear theme of, Atmanirbhar. There is a theme on improving the whole startup ecosystem. So government has been quite focused in putting this as its way forward. So in terms of manufacturing and startups, there have been increase in the sunset provisions, under which the new manufacturing setups can continue to get the lower rate of tax, and certain other benefits around the impetus on GST on any kind of import tariffs have also been included. In terms of infrastructure, which has been a thrust of this government, they are very clear to bring in many more sectors or subsectors into the definition of infrastructure. There has been a clear focus of keeping data.
We can't hear you. I think it's just breaking off.
Sure. So no worries. I'll cover this off. And the SEZ Act replacement that Prashant was referring to, basically, it's an overhaul, and this notification is yet to be made. This detailed guidelines are yet to come out in terms of what this exact overhaul would entail. And we have an IFSC related topic which we will discuss, and the SEZ discussion will be part of it. And I'll cover that off. So maybe let's move on to the next slide, and let me take up some of the key tax, direct tax, and the regulatory policy level issues. And of course, the budget has a lot of provisions. We've tried to capture a few of them which we believe may be of relevance and in terms of importance for this audience. So, there were some key announcements for investors. And to start off, the first one being on the ease of doing business front. There is a reference to accelerated corporate exits. Now, as you all would have heard about this, that entry into India is something which constantly the government has endeavored to, ease the process in terms of setup of company, making it easier and faster. And it was one of the significant points which the government had in its agenda to move up in its ease of doing business ranking. However, often what we heard from the investors, especially the global investors, was to say that, the exit is not as easy and it's very, very time consuming. So I think the government has, listened to that, and there are provisions on the ease of corporate exits, and a lot in terms of, the digital IT systems, which will be put in place to enable a faster closure of a business as well. Then in terms of, the concessional tax regimes. So at present, we have, a very attractive tax regime at the rate of 15% for new manufacturing companies. But there was a sunset clause to it in terms of, by when you could set up to be able to get this benefit. Now that has been extended, by another 2 years. So even if a company is set up by March 24, they can benefit from this beneficial regime. So this is a good step, especially considering the past 2 years, in the COVID scenario, where a lot of such investment could not have happened. And therefore, this extension of timeline is a welcome move. Next, on the measures to aid private equity and VC investments. Overall, across the world, especially in India, we've seen an extensive amount of investments, in the PE and by the PE and VC, in the Indian space, including in startups. Now, with the importance of this, the government has announced setup of a specific expert committee to examine, and suggest appropriate measures to facilitate the private equity and VC investments. And as per the reports, the amount of investments that we've had has been phenomenal. So this committee and its expert suggestions will only pave this way further and give a further boost to the investments from the private equity and venture capital funds. Continuing with the tax incentives for the startups, also for startups, we have specific tax benefits, a tax holiday which has been announced, and this also had a sunset clause. And just like in the manufacturing company regime benefit, here also there has been an extension of timeline which has been provided for the setup of the startups to be able to get that benefit up to March 2023. So again, all in all, a welcome step. This shows the government's continued intent to have startups as well as the manufacturing new companies avail of these incentives. There has been a lot of thrust, like I said at the beginning, on the digital economy front. So there is a lot of push for digital payments on national digital health and education ecosystem, and a lot of announcements on this front were made. And the last one that I'm going to cover off is on the sustainable growth front, where, in terms of the raising of debt by the government, a lot of green bonds issuance is something which we should see in this 22-23 financial year, which will be, looking at further, sustainable projects to be put in. So again, India was, I think, one of the first countries to have also had a launch of the green bonds a couple of years ago. And with this specific measure, we should only see a lot more thrust on the sustainable growth agenda, and also funding coming in specifically on the green bonds front. So with that, let me move into the specific direct tax proposals and the changes. If we move to the next slide, please. Right. So this is a quick look at the tax rates, and one doesn't need to go through each and every line, and you may find a lot of data here. But essentially, the point really is that as they say, what's not broken, you can't fix it. So the rates in India were already pretty attractive, be it the new manufacturing incentives that I spoke about, or the overall corporate tax rate. And what you see here in the highlighted portions, these are the effective tax rates for a manufacturing company, close to 17%, and for other regular companies, effectively 25% tax rate. And then in some other cases, it used to be close to 29.12%, including surcharge and cess, depending on the kind of company that was there. So essentially, no rates have been changed. So no change on these rates, either on corporate tax side or on the personal tax rates in terms of slabs, because I think they were already quite attractive and at par with even some of the European countries, like, a rate of 25% is comparable to the Netherlands, for example. So what they have done is there has been a change in, the surcharge rate. So, for example, for the long-term capital gains, the surcharge, has been capped to 15%, which could go to as high as 37% earlier for the non-corporate assessees. So this used to be a very, very high tax rate, especially for the high net worth individuals, which used to lead a very, very heavy burden on the long-term capital gains tax. So that surcharge has been capped to 15%, which is a big relief and much called for. And likewise, the surcharge on taxation of, consortiums, which are called as association of persons, there also it's been restricted to 15% from 37%. So that's the rationalization in terms of the surcharge rates which has been made. But other than that, no tinkering with the tax rate. And it wasn't even expected, given that we were already in a good zone, so to say, so far as our tax rates are concerned. So moving on to the next slide, please. Right. Now, I'll take a moment to explain the concept of an international financial services center. And there are some very key announcements again made by the Indian finance minister in the budget for IFSC, the short form. So, IFSC is essentially, as a background for those of you who don't know, it refers to our own India's financial services center set up in the state of Gujarat, and it's called the GIFT City. The objective of India and the government's vision is to pretty much have our own financial services center, which is as attractive and comparable to the developed countries, the likes of Singapore, London, Tokyo, and all of these financial services hubs that you have. So with that intent, and the IFSC center announcement was made way back, I think in 2016. But it's got a lot of push and thrust now. And in the last few years, we are seeing a lot of regulations which are being announced for government to provide a much needed boost to this. So this is the first of its kind, the Indian Financial Services Center to be set up in the GIFT City in Gujarat. What it essentially does is, it is for all foreign exchange purposes considered as a territory outside India. So when you set up a unit there, you are a non-resident. So to a lot of extent, all the benefits that are available to a non-resident, or a regulation that permits non-residents to do a lot of business functions, they are allowed to an IFSC unit. And within the financial services, there are a lot of sub-segments like the banking, insurance, captive center of financial services players, and several others who can set up units there and benefit from this. There is a tax holiday of 10 years on the income tax side, which is provided to a unit which is set up here. And a reduced minimum alternate tax, exemption on capital gains tax, a lot of state incentives such as stamp duty exemption, electricity duty subsidy, etc. All of that is already provided for even before this budget announcement. So these fiscal incentives were already part of our provisions. In this budget, what they have done is they have made a few further announcements to make this more attractive. Take, for instance, there has been a specific exemption provided for transfer of offshore derivative instruments or over-the-counter derivatives. Some of these instruments, this needed clarity that if you're doing this trading in these financial instruments from an IFSC unit, you will get an exemption. Then there is a tax exemption provided on the securities managed by a portfolio manager who's based out of the IFSC. Another interesting incentive, and also it may be very useful for the Dutch as well as other European investors as well, that there are incentives provided. For example, already there were provisions for lease of aircraft. So today we all know, like, Ireland is looked at as the hub for aircraft leasing. This is an attempt by the Indian government to say that if you were to set up your leasing function in IFSC, it could benefit from the tax holiday. And of course, I haven't talked about all the world-class infrastructure and other facilities that they intend to provide here. And it's already up and running, so it's not something futuristic. But as we speak, there are more than 250 plus companies who are already there, set up in IFSC, either in the free zone or in the taxable area. But nonetheless, it's a very, very robust sort of a function which has already been set up. Now, coming back to the aircraft leasing discussion, this incentive has now also been in this budget extended to the shipping companies. So, take for some large, European shipping or aircraft leasing companies, if at all this is something which from a business perspective they would like to evaluate, they can consider setup of a unit in IFSC. And when they earn income from this leasing business, there is a tax incentive given to it. So it'll be pretty much an exempt and a tax-free income for them. And, in order to make this attractive for the foreign investors, the Indian government has announced certain additional steps which are just beyond tax and regulatory and fiscal incentives to say that, there'll be foreign universities and institutions which will be set up here. Because if you want to create a full ecosystem and infrastructure in this particular city, there needs to be all the other aspects in terms of education, etc., available and top class ones. And therefore, we should see some entry by foreign universities here. And they will not be subjected to regulations otherwise, except and the ones which are prescribed by the IFSC itself. The next thing is that there is always an issue about arbitration, and we've heard this from a lot of foreign investors that we would like this to be subject to an international arbitration, the legal contracts between parties. So there has also been an announcement of setup of an international arbitration center in IFSC. So all in all, directionally, a lot of incentives and a lot of policy announcements have been made, and the government is actively working towards, practically giving, life to these announcements so that it becomes very attractive for the foreign investors and the non-resident players to actually set up, an office there in IFSC. This was just a snapshot. There are a lot of nuances to this. The one thing that I'll just add is that on IFSC, the regulatory authorities are very, very open to discussions. So today, for example, the change that I talked about in the shipping industry, it's an outcome of a representation having been made by a lot of industry players. And likewise, a lot of other announcements that have been made. So it's an opportunity for people to discuss, and they're very, very open to discuss specific facts of a particular case and offer this beneficial opportunity. So something worth considering in the relevant business models, and I'll leave this topic and I'll move to the next in the interest of time. Okay, now the next one on the taxation of virtual digital assets. I think this has been by far the most talked about tax provision, and loosely being termed as tax on cryptocurrency. At present, I would like to clarify, and this is something which the finance minister stated after the budget announcements as well, that codifying a tax provision for taxation of virtual digital assets does not mean that the government has legalized the cryptocurrency or the other virtual digital asset regime as such. It simply means that they know that people hold cryptocurrencies, and I think there are some very, very impressive amount in terms of the number of cryptocurrency holders in India, as well as the amount of investments that has been made in this segment. It's just to say that government not wanting to lose its share of taxation from that they have codified the tax laws. But very clearly they have stated that this does not mean that there is a legal sanctity having been given to the cryptocurrency investment. But it is likely that there is a committee which is being set up and they will look into this. So what people are expecting, that given that there is a tax provision which has been provided for the cryptocurrency taxation, or the VDA tax as we'll call it for short, that at least indicates the government's intent to also codify in terms of regulations. But clearly this should not be taken as a provision to say that this also means that it has been legalized, because there is no regulation at present. The Reserve Bank clearly has not prescribed for any regulations around cryptocurrencies. So what the tax provisions have done is that there is a specific provision now which provides that virtual digital assets, including crypto assets, and there is also other kind of financial instruments like NFTs, which are non-fungible tokens, and other digital assets except currencies as defined under the foreign exchange regulations. So, the digital currency or the currency, in terms of the rupee notes that we today have, which is already prescribed as a legal tender under the foreign exchange provisions, that is excluded for sure. But the crypto assets or the other, non-fungible tokens and those are the assets which are forming part of this definition. Now, what they're saying is with effect from 1st April 2022, any gain that is made from the sale of this VDA, it will be taxed at the rate of 30%. Now, I think the government is really trying to make it as a high tax element, and therefore they have provided provisions like no deduction for any expense, which is otherwise available in a typical capital gain calculation. So you can only reduce the cost of acquisition, which has not been defined, but no other expenses will be allowed. Likewise, today, take for instance, you incur a loss, after selling the crypto or the VDA. That loss is not allowed to be set off with your other income, right? So there is clearly a disincentive from a tax point of view when you hold such assets. And in order to track this better, the government has also prescribed for a withholding tax at the rate of 1% on transfer of VDA to a resident. So basically, what will happen is, say, with effect from 1st July 2022, when you are having a transfer of a VDA, a virtual digital asset, then a withholding tax needs to be applied at the rate of 1%. This is simply to track such payments, because then this will become part of the records of the tax authorities and they can better track it. So the rate is not high, but a 1% rate has been applied for the simple reason that they would like to track these transactions better. And even if you gift a virtual digital asset, that's also taxable under the specific provisions of the income tax law. So, so this is a very important announcement. And, just again, to bring a little bit of a semblance from a European perspective, I do understand that in the EU also there are some talks of having specific tax legislation on the cryptocurrencies. So internationally, in some countries, this is even considered as a legal tender. For instance, I think some of the states in US also allow for it. So there'll be a lot of issues as this thing picks up in the near future, in terms of people starting to accept this currency, for example, as a discharge of a payment of consideration, right? So anybody providing services, and instead of getting money or cash for it, they starting to receive consideration in the form of a virtual digital asset, in form of cryptocurrency. So a lot of these issues will come up. I think this is the start of a very, very important provision so far as India is concerned, and this is going to have a lot of implications. But I think as of now, everybody is watching out in terms of the legal regulation itself as to what the Reserve Bank does and when it does in terms of codifying the whole thing. But for now, for all the holders who hold any cryptocurrency and are making some profit out of it, clearly there is a tax bill that is hanging there. But that's no surprise. I think from times immemorial, we've had smuggling income also getting taxed. So clearly there is no such thing in terms of a surprise. But yeah, the provisions are clearly providing a lot of disincentive by not allowing any expense deduction or a loss set off, etc. But I'm sure we'll have a lot more on this subject in future to discuss. Okay, so moving on to the next one. Right, so there are a host of other issues on the direct tax side, a lot of other proposals, and I've only picked up a few in the interest of time. There is one provision which talks about the option of filing an updated tax return. Now, this is not a revised tax return or a belated tax return, but the government is giving an option for a taxpayer to file tax return within 2 years from the end of assessment year. And this is effective from 1st April 2022. So let me share a little bit of the perspective and the context of why the government has announced this. So today there is a lot of tracking of transactions For those of you who would have noticed in your own tax return filing this year, there is a lot of, there's an annual information statement, a transaction level income statement, which the government today already has. So the kind of transactions that you've done, the holding of financial securities, shares, etc. So the government is privy to a lot of information, and which is coming from other sources, from the annual information returns which the corporates are filing or the financial institutions, banks are filing. Now, to allow for a taxpayer to take benefit from that information, if there is an erroneous disclosure which was not made, or some income which was not considered by the taxpayer in its original return, then they are providing a very extended amount of time. So 2 years from the end of the relevant assessment year, which basically means 3 years from the end of the financial year. So for a financial year 22-23, you get time up to 31st March 26 to file this updated return. It does come with a rider that you need to pay additional tax. If you do it within the first year, you have to pay an additional 25%. If you do it after that timeline, then you have to pay an additional 50% tax. So clearly not something which is going to be very easy on your pocket. But if you want to come clean and do want to disclose this, this is an option. However, one should take care that if you already have received a notice for assessment, then this provision is not available. So this applies only when your case has not been picked up for scrutiny by the tax authorities. Then you have an option to use this provision. So for a lot of corporates who are regularly assessed, this may not be of much use, so to say. But individual taxpayers or otherwise who really want to come clean and want to disclose and have got some information later can make use of this. The next proposal is on the COVID-related payments. And this was also an industry ask, and not surprising at all, that they have provided exemption for the sum received on account of COVID, in case of death by a person and you receive some consideration from the employer, or providing deduction to the employers who have incurred expenses for treatment of COVID, for the employee himself or their family. So relevant exemptions and deductions have been provided for such expenses. The last point that I have is there has been a clarification that if there is a payment which is made in contravention to a law, Indian law or a foreign law, that expense will not be allowed as a deduction from your business profits. Now, this was historically also there for but it was interpreted, or the provision clearly only restricted it to expenses that you make in contravention of the Indian law. Now they have extended this also to foreign law. So to that extent, this expense will be disallowed for business purposes. While there are several other provisions on the direct tax side, I would now like to hand it over to Shailendra to cover off the indirect tax and the customs proposals.
So thank you, Nidhi, very much. I think I would reserve my questions to the Q&A session, and I would welcome Shailendra Saklecha, who's a chartered accountant with about 16 years of experience in the field of indirect taxes, and he's been consulting and advising a broad range of Indian international clients across multiple industries, including healthcare, FMCG, manufacturing, and services. So Shailendra, the floor is yours. And then obviously there'll be more questions of you as well. So please welcome Shailendra.
Thank you, Rageshji. Thank you so much for the hearty welcome, and thanks, Nidhi. So maybe as we start off on the indirect tax proposals, we will cover the GST and the customs related amendments. But before that, I just wanted to talk about two specific themes of the government, right? One is making the budget a non-event as we go along and making it more of a policy statement. And that is something we have seen absolutely coming out in the indirect tax proposal. I'm sure it's something we have seen even in the direct tax proposals as well. And therefore, the good news here as well is that there is not much change, but some of the changes which have been made has been the industry ask either, or something which probably there was a lacuna in the law, or there has been some judicial precedents in the past which has pointed out those lacunas and they have rectified these issues. So that is one specific theme, and the other theme obviously has been the boost on manufacturing and the Atmanirbhar Bharat. And we have seen in the past, for any investors into India, so many PLI schemes have been released. I think we have had 13 PLI schemes already been announced by the government, and almost 10 of them, 9 or 10 of them, we've already seen that the application dates are closed, and 3 of them are continuing as we speak. And the indication from the finance minister in this budget was that there would be many more PLI schemes that would come out in specific sectors where the government intends to increase its footprint on manufacturing aspects and reduce the import dependencies. One of them was certainly the renewable energy, and she talked about solar panels, and we'll have to wait to see. There is already a PLI which has come in for solar PVC, but I guess there would be another additional PLI scheme with an additional budget outlay to cover the renewable energy. She also spoke about the drones, right? So, drones being used at the agricultural level, and therefore our discussions with the ministries also suggest that while one of the PLI schemes relating to drone manufacturing was released, but the outlay was too short. It was just 120 crores, and I don't think that's sufficient for the scale and size of the requirement that we're looking at when you talk about this in India. So another big one, possibly on drone manufacturing, is likely to come in this fiscal year as we speak. So PLI is another theme which is running and running very successfully. And let me also specifically call out that we are doing a lot of projects on PLI, and the body language of the government authorities is completely different than what we have seen few years back, right? It was always difficult to get money from the government, but now the policy statements, the guidelines are pretty clear. If you need any clarifications, they do provide it well in advance before you make an application. So from all those fronts, it's a very positive aspect for any investors to come in and invest in India. So these are the two the policy level themes I wanted to touch upon before I get into the specifics of the GST amendment. Now, from a GST perspective, I would touch upon only two specific aspects. While there are a lot of amendments, but those are very procedural, and I don't want to bother this group with all of those. But one of the important amendments, what we have seen is the additional condition for availing the input tax credit. Like, if you see anywhere in the globe, you have a VAT regime, right? So whatever input taxes you pay on your raw materials and capital assets is available to you for an offset to pay the output tax liability, right? And the same concept is there in GST as well. But when you have to take a credit, input tax credit of taxes paid by your suppliers, there are certain conditions. When you fulfill those, you are entitled to take a credit. Among those conditions, they have added one additional condition now, which is something which surprises me a lot, and none of us really expected that to happen, because that condition is linked to the compliance of your supplier. Now, if your supplier doesn't comply to the regulations, doesn't pay taxes on time, you will be restricted from taking the input tax credit. So I think they have shifted the burden of you being impacted because of non-compliance from your supplier's perspective. So what does that mean? That means that selection of supplier is critical. Second, reconciliation of the items where you can take a credit, you can't take a credit. I think the compliance burden will increase. If I have to put it in one line, compliance burden is likely to increase because of this amendment. And third aspect is you need to look at contractually whether the companies are protected to recover this amount back from the supplier in case there is a litigation which happens because of a non-compliance at their end, and there is an interest and penal consequences which the companies suffer. So I think that is something which the industry did not expect and has come in. The other very procedural part is that there is a timeline within which you can take the input tax credit, and that is typically if there is a financial year 21-22, any procurements that you have made for financial year 21-22, you can take the credit by 20th of October of the subsequent financial year. So you have a leeway of another 6 months to do the reconciliation and take the credit. So they've extended that by a couple of months in that. So I think that's a welcome move, but the only ask from the government would be to clarify this, whether it's 2 months or 1 month, because there are debates which are currently underway, given the wordings in which this particular amendment has come. And as Rajesh said, when you look at the fine prints, though intent looks to be 2 months, but the provisions doesn't indicate that. So I think it would be good to get a clarification from the government. Otherwise, on a conservative basis, treat that as 1 month and get all the reconciliation and past related adjustments done by October. Moving on to the next slide. Right. So other, the important aspect has been that the interest rates, there has been interest rates varying from 24% and 18%. The government said, no, nothing doing. We'll keep it at 18% standard for all types of non-compliances or delay in payment of taxes. So that's a welcome move, and that has been effective retrospectively from 1st of July 2017. So a beneficial piece of legislation making effective from a past date, which is from the introduction of GST, a very welcome move again here. The other ask from the industry has been that, in case of a GST, you have registrations in multiple states, and you have situations where you are sitting on a high input tax credit or an additional cash balance in your electronic credit ledger, which you are not able to utilize in that state. And the ask has been that please allow us to utilize against our output liabilities in other states. See, the government actually has partially accepted that request, and they've allowed the cash balance ledger account to be adjusted fungible to other registrations under the same PAN, which is under the same legal entity. But that's too restricted to IGST and CGST, which is well understood because these are the taxes which the state government gets, and SGST is something which the state government gets. So you can't do that adjustment at that level. The other proposals are pretty much in line. They have just the way the system, GST and system is working, they have made that specific aspects in the law itself that, if there is any return that you file, you need to first file the return of the past month. If you haven't filed it, you can't file the return of the subsequent month. And that is how the GST and or the technology network of the government used to behave earlier. So they have made this as a part of the law so that nobody can challenge that what is there in the law and the technology behaves in a different manner. So that's the parity they have brought in as a part of this amendment. Right. So I think moving on to the customs related amendment, if I have to speak, nothing major, but two important themes again coming out. One is rationalization of customs tariff based on the international levels. I think internationally the customs tariff looks at classifying certain products in a manner, and our customs tariff has been there age old since 1975, and it required a sort of a relook and rationalization, and that's something which has been done and is effective from 1st of January 2022. The other important aspect, which typically is popularly known as tariffization. So earlier what the government used to do is there is a customs tariff, and under each of these entries in the tariff, you have a rate of duty applicable for import. Let's say it's a product X, and the rate of duty is 10%, which is specifically mentioned in the tariff. Thereafter, the government always used to issue notifications to either reduce that particular rate of duty from 7.5% to 5%, 2.5%, depending on the requirements. The reason why the government always intended to have a higher duty in the tariff is because tariff change means and requires a parliamentary process, and that can typically be done during the finance, when the finance minister presents the budget, so which is once in a year affair. But notification is something which you can issue as you want, right? The authorities can issue as they want. But this year they have done a complete reverse manifestation of this. They've said no, nothing doing. What we will do is we will remove all the exemption notifications which are unconditional, and that's applicable to everyone. Whatever is the rate applicable there, we will get this in the tariff itself, which essentially means that the government binds itself with a specific rate for at least a period of time, which is 1 year. You can get a certainty at least for a year, and there will not be any changes, at least in the interim. I think that's again a very, very bold step, which they have been following for, the past has been there for almost 35, 45 years. And it was really bold to move out of that and make this change. The other important aspect which I want to just talk about is advanced ruling validity. This is again a surprise to us. Whenever a new business starts, right, any multinational companies do want to get a certainty on the tax rates, and therefore they approach the advanced rulings for that matter. Same is the situation for customs as well. And prior to this amendment, an advanced ruling which is obtained, so far as the facts and the position of law remains the same, the validity was perpetual, right? But now they are saying that irrespective of the fact that the facts and the legal provisions remains the same, it's going to be valid only for 3 years. Now, what happens after 3 years, whether you can reapply for advanced rulings, how do you revalidate that, renew this advanced ruling? I think those are the questions which still remains unanswered. But this is another change which typically would impact many companies who have gone through the route of advanced ruling, obtaining advanced ruling on certain aspects of the transaction. And I think these are some things we have already talked about. The final point from my side is government is moving directionally, reducing the exemptions as we go along. And I will not be surprised in the next three years or so, we will reach a situation where currently whatever exemptions we have, we will just be tuning it to maybe 5 or 10%, which is for the public interest. Otherwise, this exemption business, so far as customs is concerned, is just going to go, and same is the situation as we speak on GST. So I think that's it from my side, and I'll turn it back to you, Rajeshji. Happy to have any questions.
Thank you very much. Thank you, Shailendra, and I think it was very, very interesting. We missed Prashant actually fully. He had to, something happened in the network, but I think Nidhi took up the mantle and she did a good job of it. But I'm sure you should be here for the Q&A anyway. So thank you. I will turn it over to my colleague Haresh Lalwani, who is the president of INBA Mumbai, for handling the Q&A. And I think Haresh, over to you, and you can conduct the Q&A session. I've raised 2 questions myself.
Thank you, Rajesh. Thank you. Yeah, I have your question, and I guess Nidhi has already answered your question on the chat.
Okay.
So this question was, how is multimodal transport defined as? And Nidhi, I believe, has already answered that question.
Okay.
And your next question was, what are the benefits to an IAF CAT3 in IFSC?
Right.
The category 3 IAF benefits.
Sure. So I'll also address that. But before that, if you have any other questions, then we can also, because that's, I can quickly sing as well. I'm just conscious of time. If there is anything else that we want to take from the audience, otherwise I'll just.
I don't think too much has come from the audience, but there is something that has been, when you speak to people saying that with the digital rupee, will it eventually replace our currency?
I don't know who wants to take a shot at that.
Prashant is back. I think he can answer few and he can give his views also.
No. So I'll pick it up on the on the virtual currency, but why don't you, Nidhi, take up the other question, and I'll chip in for the PTA.
Right. So anyway, coming to I think one question that you said on EPCG, I'm sure Shailendra will cover off. The question on AIF category 3 investors, right? So AIF has different categories, and this category 3 benefit that I had mentioned is already available today in IFSC. And basically, these are the AIFs which deploy diverse, complex trading strategies. So, there is a specific category of funds which have exemptions from the investment that they have in listed or unlisted derivatives, and the income that they derive from it is exempt. So that's what it is. And further announcements were made to address some of the other, the over-the-counter derivative instruments, etc., which was not clear at present. So that's on the. I think there was one more question, Harish. Did you say that? When will digital currency replace the economy? So,
sorry, would it eventually replace our current currency, or what is the real purpose behind coming up with a digital currency?
If I would like to take a shot on this, Harish. See, I don't think it would going to be so easy for the virtual currency to replace the actual currency or the currency which we've been used. See, our demographics are such where it will not be so easy to replace this completely. But I think if we are looking at it more in the urban economy, there is a drift of moving from a cash economy to a more digital economy. I think it would also need to be seen that how some of the measures which the government is planning to announce quickly in terms of curbs and frauds to be measured and to be monitored, how people will be comfortable using this more and more. So to answer this in specifics, I think it's a great move. It's still not completely legal. We need to wait for the measures from the RBI in terms of how they are planning to create a platform. But I think it was very important for the government to try and plug this, at least from a taxation perspective, because if we see the HNIs and the ultra HNIs, they were already looking at this as a mechanism for investments and try to look at it more as a measure to earn, I would say, income. So if you see the provisions of the law also, it not only includes Bitcoins, but it includes all forms of virtual currency, right? So effectively, that is largely to plug and say that we are watching and we are looking at monitoring this very closely. But to your point that will is going to replace so soon, my answer to this is it would not be so soon.
So how does the digital rupee be beneficial for the common man?
So see, the fact is, as we see, if you see the demographics of our country, even digital payment, if you see 5 years back, was not so much conducive to a common man. But today, whether it was COVID or for any other reason, our dependency on the digital transactions or the digital payments have been quite different. If you ask us people or on this platform, how many times you have gone to a bank to transact in the last 2 years, the answer would be hardly, because most of us are now so dependent upon the digital transactions. So I think it's all about getting used to it. So one is a digital transactions and one is a digital kind of a payouts. I think the transactions would be easy for people to carry out. Whether the form will move from cash to digital, I still feel it will going to be difficult for a common man to adjust it so soon.
Fair enough.
So I think the purpose today was different, to be part with the world and move with the world and try to curb it to the extent they can and try to monitor it. But I don't think it's going to be so easy to replace this in the next, say, 4 to 5 years.
Thank you. We have another question, and this is, I think, for the new manufacturing company, is it expected that the company should be capitalized without bank borrowings and needs to invest in new equipment? And can they operate out of rental premises?
Right. So that's a good question. Yes, CapEx is required, but having a rental premise by itself is not a deterrent. So you can have some amount of old transfer from your existing business, but there is an anti-abuse. So you can't pretty much set up and move your existing old plant and machinery, so to say, into this one. So there are anti-abuse provisions in it. So essentially, it is to promote new capital investments. So significantly, it should be that it does allow for some bit of transfer, but not a very significant one, which you still can do from the earlier one. I think these were the two questions, or did I miss anything?
That's right. No, that's perfectly right. Okay, I have another question for Shailendra. This is basically regarding the tariff being continued for one whole year. Would this also include apply to anti-dumping duties?
No, anti-dumping duty is not, because anti-dumping duty, they can, so anti-dumping duty, you don't have a schedule, right? They can bring in the anti-dumping duty, basis the need by way of a notification, which they are free to do at any point in time. And what I'm talking about is only the basic customs duty, which forms part of the customs tariff.
Yeah, because usually it's the anti-dumping duty that comes in and spoils the game. So,
yeah, no, but anti-dumping duty is outside.
Okay, Nidhi, that Mr. Narendra, who asked this question about the bank borrowings, he wants to know more about the bank borrowing, whether you said
right. That was the other question. I knew I was missing some question. Yes. So, this is typically called as like, the thin capitalization norms as we have in Europe, etc. So there is nothing specific for the new manufacturing company itself. We do have provisions under our law which do talk about, it's called 94B, but it only applies in very specific situations. So to answer your question simply, and that applies when you have a borrowing from a related party overseas, etc. So in normal situations, even if you're using debt to finance your company, there is no prescribed debt equity ratio rule. So to that extent, you're fine, so long as your 94B provisions are complied with. But that only applies in international related party transactions.
So just to add on this one, even though you would have a financing from your related party, but the coupon which you're going to pay has to be mark to market. So basically, since this is more like an anti-abuse to justify that you're not taking more profits which are at lower tax rate. So in case this new manufacturing unit is actually paying an interest coupon to its related party, the idea would be that this interest payout should be mark to market. It should not be a situation where you're reducing the interest cost so as to have a situation of a higher profit which is getting taxed at a lower tax rate. So the coupon needs to be mark to market.
Fair enough. Okay, Nidhi, one more thing about shipping lines. You said a shipping company could come into the IFSC and set up their own organization or a company over here. Now, how does that work? Does that only work for the international transactions that would take place, or would the profits of the domestic shipping and the domestic part of the shipping also be calculated, or would also be given exemption on taxes or?
Right. So good question. So actually, the essence of an IFSC unit is to have, the foreign currency income, and it is basically meant to attract foreign investors to set up base here and pretty much have a parallel treatment as they were to get had they been non-resident investors. So take, for example, any European-based shipping line, which was to, which would be having a shipping leasing transactions, as you have also for aircrafts extensively. So the leased income that they earn for that non-resident, because he's earning, that income from its foreign operations, to that extent it is exempt. But so far as the Indian revenues are concerned, the money that you earn locally from India, that, just like we've always had export-oriented benefits, to that extent, the exemption only, applies when you are earning foreign currency. So it will apply to the overseas business itself. However, what can happen in some typical transactions, it's very interesting, is that another company, let's say set up in IFSC, is also treated as a non-resident. So to that extent, when you have operations or transactions with that entity, even though it's an Indian company but set up there. To that extent, also it is treated as an equivalent to a foreign transaction, and that will also qualify for the benefits.
So you were saying a lessee and a lessor in IFSC would benefit from those transactions.
If they are both set up in IFSC and if their business model enables both of them to then earn.
Naturally, a lessee and a lessor,
Yes.
their business model is that there has to be a lessee to a lessor.
Yeah. But I'm just saying both of them independently earning foreign revenues. So yes. Then
this brings me to another point of when we're talking about aircrafts and ships which are being leased. Now these are completely different compared to containers also that are being leased. So if a container is leased from a foreign company by an Indian organization in India for international transportation as an NVOCC, then what happens?
So I think this is worth evaluating, because the shipping one has just been introduced, right, in the budget provisions. This has just been allowed, and in fact, I also want to mention this, that even if there is any lack of clarity, for example, on its applicability or to a container situation that you just mentioned, there is a possibility for us to either make a representation, because this is only a budget. It has not been Finance Act yet. So a lot of representation can also be made if there is no clarity yet. But I think it's early days to, one needs to go through the regulations once they are out in details to say to what extent, under a shipping scenario, would it also extend to a container. But, happy to have that discussion in more details, and also
Anytime.
then
I'll be happy to give you all the inputs on that, because
Absolutely.
that is what the Indian industry is facing today, especially people who want to have their own equipment and be competitive enough with the international companies. They cannot do it. So one is because of this particular reason, and the second is that the moment as an Indian, when a company takes containers on lease for international transport, they are still subject to GST on the international lease, which is to be paid, on a reverse basis.
Right.
So you get me where I'm coming from. So
yeah, and in fact, there are actually, and challenge can chip in. There are actually a lot of aspects on GST side also. Some of them are somewhat clear that there will be an exemption on the GST side also in IFSC, but some aspects are still a bit grey. So you're absolutely right that the GST aspects also duly needs to be considered.
And I guess we have some more exemption. Withdrawal means EPCG goes. No, sorry. Is there a difference between an Indian company or an international company established in IFSC? An example.
So like I said,
incentives.
Yeah, so like I said, that unit, or it could be in the form of a branch in certain situations, like an insurance group or a banking company can set up a branch in IFSC, or you could have your own company having been set up there. So it could be a subsidiary of a foreign, player, an NBFC, so to say. So all of those are eligible units so far as IFSC is concerned. And so the difference, like I said, from a foreign exchange regulations, you are considered as a non-resident. For tax purposes, of course, you are an Indian resident, but you qualify for exemption on the income tax side, subject to all those qualifications. So that's the way I would put it. But like I gave an example, like, foreign universities will be looking to set up. They'll be exempt from a lot of regulations otherwise, which may apply to a foreign university which sets up its presence anywhere in India, as against IFSC. Because what they've also come up with is a single window clearance mechanism. So take, for instance, even, some broking entity today, which today needs to be governed by SEBI regulations. They will necessarily need to get that license separately and host of those compliances. Then you set up under IFSC, you have a single window clearance, so to say. There are two registrations because it is set up as an SEZ. So the IFSC tax benefit also comes up when you do set up a unit in that SEZ. So that's one approval. And the other is the single window clearance through IFSC. And they will internally, so the SEBI registration, etc., all of that comes through with that one application itself. I just wanted to add that to your question. Yeah.
Thanks. And a continuation to the question before, does IFSC have an impact on tonnage tax? I know it's a little too specific, but that's the question that's on the chat.
Yeah, I think we'll need to analyze, but like I expect that if you're an eligible foreign entity set up in IFSC, then I think you can take an exemption from the Indian tonnage tax regime for the simple reason that you'll qualify for an exemption under the IFSC setup itself. Tonnage tax otherwise is a specific mechanism in which foreign players can calculate their taxes. It's an alternate method to pay tax. However, if you're qualifying under an IFSC setup, to that extent, in my view, that it should be exempt. So the income tax regime on the IFSC side should apply. Is what is my first reaction to that. Of course, can be looked at in a little more detail.
No, I can understand. I know it's too specific a question to a certain business, but yeah.
Right. Yeah, but definitely goes on to show, I think IFSC does end up having a lot of interest as well as questions and issues. So clearly something where I don't know, Rajesh, if you think appropriate, there could be a follow-up discussion on this topic itself, because I don't think any justice can be done to it in a short time, so to say.
No,
I totally agree that we should have, something which is specific to IFSC.
Can't be. I think it just occurs to me and all my colleague presidents as well. But I think we should have a session each separately for direct taxes and indirect taxes. You can't combine the two. Otherwise questions can't be answered, and obviously they also are a bit hurried. But wherever we are, I think we need to end the Q&A here because we are kind of out of time. Harish, can I thank you before I pass on to Rob for the closing remarks? I think I have the pleasure of welcoming also Chakravarti AVPS. So nice to see you. He just fought COVID, all his family. So we can see him on the screen. And if you want to say a few lines, please go ahead before I invite Rob.
No, thanks, Rajesh. I'm also looking forward to listen to Rob as well. I just messaged to him also. But nevertheless, thanks for the cooperative leadership provided by you, Mr. Rajesh Srivasav, and my dear friend Harish Bhai and Amit, Marian, and Rob, and all of you guys. And then, of course, KPMG as usual coming to our knowledge enrichment, I can say, the way Nidhi handles, even in the past webinars also, the presentations and the Q&A. And it's a great enrichment for all of us. We look forward to more and more sessions like this with the cooperation with KPMG. Thank you very much. From INBA Hyderabad.
Thank you. I have the pleasure of inviting Rob Tolinas, who's the CEO Asia and Africa for Sweeps Part Private Limited, and also the treasurer of INBC Bangalore. He stands it very well for Marian Franzen, who's the president of the Bangalore chapter. Rob, the floor is yours for your closing remarks and also for thanking the speakers.
Yeah, thank you very much, Rajesh. It was an absolute very informative session. And in order not to make it very difficult to pull out each of the names, I would really like to thank all of the presenters, but also the participants who were really, very, let's say, interested, seeing the number of questions. So it became a very interactive session, and I think that's great. Furthermore, what has been highlighted by KPMG on the union budget, I think a few things come to my mind, and it has been said already by a few. Digitalization is something, we cannot escape from anymore. So this is something absolutely going to determine a lot of things in the future. I was happy to hear and to read that there is government attention to these startups, and also the attention for a more sustainable world and more sustainable economy. I think digitalization and sustainability are issues which will determine a lot of our common future. Yes, and then the issue about taxes, well, I'm for certain not a specialist. For me, taxes remain to be complicated. But when I heard I could have, well, not me, but when I listened and heard that there is such a thing like a 10-year tax holiday, I immediately became very happy. I think, well, that sounds great. But I know even that is not, let's say, not so easy with the IFSC, but it opens possibility for certain companies. Being late is always expensive, and I understood that being late is now, let's say, if you still bring up your taxes, it's fined, or more or less fined by 25%, and another year later is 50%. So that sort of fines, I even think, are not, although I'm not a tax specialist, applicable in the Netherlands. But yes, I think it's good that this is there. That keeps people more on the track of compliance. Also, what I heard about compliance on the GST, makes one think twice with what you conclude with your suppliers, and that you're certain that your suppliers indeed are compliant. All in all, I would like to congratulate everyone for this absolute great session. Yes, I understand also from everybody there are also, of course, after this session, still a lot of questions. But for me, it gave quite a nice overview, and I'm quite convinced that for all the participants that has been the same. So thank you all again, and hopefully we'll meet again somewhere, somehow.
Thanks, Rob. I just recalled the interview of the finance minister I watched last night on Times Now with Navika, and on taxes. And Navika asked that middleman, common man was expecting reduction in taxes. So she smiled, she said, but I haven't increased also. So that is the spirit. So I think that's true. And Nidhi made that point that we are in that, the average bracket or the lower bracket globally. So that's fine. Okay, with that, let me call this session to a close. And thank you again very much. I must thank all of you to be here, and especially my colleagues from Hyderabad and Mumbai and Bangalore, and also the KPMG colleagues, the speakers, and also our INBA IDCBS secretary, which is Swapna. She's also on the screen, for all the hard work. Thank you, Swapna. Thank you all once again, and have a very good evening.
Thank you.
Thank you
Bye-bye.
all.
Okay.